Okay, Assalamualaikum and good day everyone. So today we are going to learn the last topic regarding the cost of capital. Okay, so from this topic, you can explain the breakdown and composition of firm cost of capital. You can explain different types of model to calculate cost of capitals. You can determine the firm cost of debt capital, determine the firm cost of equity capital, calculate weighted average cost of capital, or we call it as a WACC, and you can understand different types of leverage as well as its implication. Okay, for introductions, usually investor required rate of return is the firm cost of capital, meaning to say that what investor have invest and what investor need to provide to get back. Okay, it's called as the cost of capital. So cost of capital is the required rate of return that a firm must achieve to cover the cost of generating funds in the marketplace. What is the factor that impact the cost of capital? So the factors that impact the cost of capital include riskiness of the earning, the debt to equity mix of the firm, financial soundness of the firm, and interest rate level in Malaysia and global marketplace. All of these factors impact the cost of capital. Weighted average cost of capital, or we call it as WACC. Okay, the firm WACC is the cost of capital for the firm mixture, which consists of a mixture of debt and also stock. So stock consists of the preferred and also common stock. So in WACC, we have debt, stock, and preferred stock. So firm usually geared or leverage using a mixture of debt and equity. So firm that use full of debt, we call it as geared, whereas firm that use use the equity, we call it as a ungeared, right? Okay, so this is the computations of WACC. So as I mentioned earlier, WACC consists of cost of debt, cost of ordinary share, and cost of preferred share. Okay, so WD, WS, WP, okay, WD is the width of debt. Meaning to say that let's say out of 100, okay, 70% is consists of debt, and then 20% consists of ordinary share, the weightage. So cost of debt, KD, is the level of return that must be provided by a firm to meet the required return of debt holders. Cost of preferred stock, or we call it as KPS, has higher return than the bonds, but is less costly than common stock. And cost of equity consists of common stock and return earning, which is the rate of return that investor require to make an equity investment in a firm. So all of these cost of debt, cost of preferred stock, and cost of equity include in the weighted average cost of capital. Okay, so this is one of the formula of cost of debt. So you can use this formula, which is interest at a time over 1 plus K. K is the required rate of return, and T, okay, plus P is the price of bond over 1 plus cost of debt, KD, and N is the year. Okay, you can use this formula to find cost of debt, or you can use this formula, or IRR, equal to A, lower discount rate. Okay, lower discount rate usually in the present value, PVIF factors. So PVIF factor in your table, okay, let's say 11%. So you compare with the 12% in the question. So 11% is the lower discount rate, whereas B higher discount rate is the 12%. Okay, and then NPV is the total of the factor and the cash. When you multiply, you get the NPV. So NPV at the lower rate is the cash times the factors of the lower rate. Just now I mentioned is 11%. So NPV the 11%, you have to time the cash. So you get the net present value for lower rate. Okay, cost of debt after tax. Okay, you are using this formula. KD equal to cost of debt 1 minus tax rate. Okay, another way you can use you can use to count the cost of debt is when you are using the irredeemable debt. So redeemable debt is KD. So KD equal to I over P. Okay, KD equal to I over P. You can also use in order to count the cost of debt. Okay, I is the interest. Very simple formula. Cost of debt equal to I over P. I is the interest over the P is the price or proceed. Okay, market price. So you can use KD equal to I over P to calculate the cost of debt. Alright. So for this one, cost of debt after tax equal to cost of debt KD 1 minus the tax rate. So from this example, you are given the tax rate is 40%. So 1 minus the 40% is 6% for cost of debt. Okay, so for cost of preferred stock. Cost of preferred stock, okay, you can use this formula, preferred stock dividend over market price times 1 minus the flotation cost. Okay, you can see from this example, okay, the flotation cost is 3%. So the cost of preferred stock, you get 12.4%. Okay, and then you can revise the formula of CAPM also from the capital budget topic. So CAPM KS, okay, cost of common share equal to K is cost of risk-free rate plus beta, and then cost of the return on the market minus cost of risk-free rate. Okay. Okay, cost of common stock, common share, you can also use this formula when there is existence of dividend and the growth of dividend. So K as cost of common shares equal to dividend over P, okay, the price market plus the growth rate. And finally, you will get dividend 1 plus growth over the price plus the growth. G is the growth of dividend. Okay, based on the discussion introduction, okay, a firm cost of capital is known as WACC. So WACC equal to W is the weightage cost of debt plus W weightage of the stock, okay, times cost of stock or return earning plus W is the weightage of the preferred stock times the cost of preferred stock. So example given to you is the cost of the bonds, preferred stock and common stock. So firm need to pay tax at 30%. So you have to determine WACC. So WACC equal to, okay, weightage, the weightage times the cost of debt after tax, okay, 0.7 because 1 minus 0.3. So you get 0.7 because this is the cost of debt after tax. And then plus the weightage times cost of stock plus weightage of preferred stock times cost of preferred stock. So finally you will get the weightage average cost of capital of 27.11%. Okay, this is how you calculate weightage average cost of capital, which consists of the debt, preferred stock and also the stock. Okay, and then weightage average cost of capital Okay, the breakpoint. Breakpoint defined as the total financing that can be achieved before a firm is forced to sell new debt or equity capital, the break-even. So, breakpoint equal to the return earning over the weight of equity. So, the formula for breakpoint is for debt or preferred stock is same. That is by replace the return earning for debt and using the weight of debt. You just replace the return earning with the weight of the debt. Okay. Next, business and financial risk. Okay. Firm business risk is attributed to a firm business and investment decision. So all our business risk is related to our decision in our business and investment when you are making decision of investment. Okay. So evaluating business risk means that variability of EBIT. EBIT is the earning before interest and tax. Okay, so business risk is related with the variability of the earning before interest and tax. So financial risk. Financial risk is a direct result of the firm financing decision, which is when you select financing mix of debt and equity. Okay, so you see here types of leverage. Okay, operating leverage, it's related with the variability of earning before interest and tax. Whereas financial leverage, it relates with the variability of the earning per share. Okay, and then total leverage or combined leverage, okay, is the combinations of the operating leverage and the financial leverage. Okay, so operating leverage is the responsiveness of a firm earning before interest tax to fluctuates in the sales. How the operating leverage is being responsive to the fluctuation of sales. Okay, so operating leverage result when fixed operating costs are present in the firm's cost structure. So this responsiveness can be measured as follow. So how you are going to calculate degree of operating leverage? Okay, percent change in EBIT over percent change in sales. Or you can use this formula, degree of operating leverage equal to the quantity and then price unit selling price. Okay, price unit minus variable over quantity and then unit price minus variable minus fixed. Okay, total fixed cost. You can also use this formula for operating leverage. And for financial leverage, you can use degree of financial leverage from the base sales level, DFL, equal to, okay, percent change in EPS over percent change in EBIT. Okay, so this one is actually DFL. So DFL equal to percent change in earning attributed to common stockholder over percent change in EBIT. Okay, earning before interest and tax. So this is the implication of financial leverage. You can just read the additional information for you. Implication of financial leverage. So finally, total leverage is, okay, the degree of combined leverage equal to degree of operating leverage times degree of financial leverage. Okay, you just use this formula for DCL, degree of combined leverage. Very simple. Okay, total leverage. Okay, that's all for this topic, cost of capital. So basically, from this topic, you just focus on the how to calculate the cost of debt, cost of preferred stock, and then cost of stock. Okay, 3, and then cost of weightage. You have to know how to calculate the weightage average cost of capital, WACC, as well as the leverage, okay, financial leverage, degree of operating leverage, and degree of financial leverage. Okay, degree of operating, degree of financial, and then the combinations of both, which is total leverage. Okay, this formula. So just alert to that calculation, okay, and formula for this topic. Okay, thank you.